Hi everyone. Today we're going to start looking at Chapter 18, which covers managerial accounting concepts and principles. We're also going to start talking about manufacturing and getting into how that's going to affect our accounting process. So let's start out by talking about managerial accounting basics. So when we think about that, managerial accounting is going to be something that's done inside of a company. So we talk about financial accounting, and obviously that's inside the company. Managerial accounting is going to provide financial and non-financial information for managers of a company, and also to provide it to other decision makers. So when we think about this, these managers, they're going to include people in charge of a company's divisions, so the heads of different departments. So let's talk about what they might need. And as we get into this, we're going to look at, to do their jobs, these managers are going to need more than just general purpose financial statements that we see from our financial accounting system. There's a lot of information that they need in addition to that. So let's think about some of those examples of departments. So if we think about sales, for example, the sales department, they're going to be looking to see if they're ahead or behind the goal that they've set up. We want to know what the sales volume is. We want to see how it's broken down by product. If it's a commission-based sales, we want to know who sold it so we know who to pay that percentage based off of that commission to. When we look at marketing, we want to look at the number of leads that are generated, the opportunities that we have. We want to look at, the possibilities for the marketing campaigns. When we think of production, we want to think of the schedule of products that we need to make, or the progress of our production schedule. We might need a list of raw materials. So there's a lot of things. Going into looking at the purchasing department. Purchasing departments might be looking at the orders that are coming up so that they know what raw materials to order, what supplies are on hand. When we think about the human resources, they're going to need to know how many employees, if they've completed trainings, where they're at. Accounting and finance, we might need to know inventory levels, we might need to know budget versus actual. And then we also might be looking at research and development depending on what kind of company it is. So they might want to need information from production on how to improve the existing products. So what kind of information, do these people need to run their departments? That's kind of what we're looking at. So what does all this do for the department heads, right? Well, it's going to provide information to help them make their planning decisions. When we look into more of the managerial side, we are going to see, what is the purpose of it? So the purpose is mainly to plan what we want to do in the company, whether it's a short-term or a long-term goal. It can be a financial goal, it might be a non-financial goal, but we're planning. So the planning process is really important. And that's where we're setting the goals, we're making plans of how we're going to get to that goal. We talk short-term, we're talking immediate to maybe it could be like a 2 to 5 year. Long-term, we're typically looking 5 to 10 year. And then we want to look at what kind of controls do we have. So what kind of things that we put in place to make sure that we are able to plan those decisions, monitor them, and evaluate to see if they were good. So those are all important parts of it. When we look at this chart here, it shows us the comparison of managerial versus financial accounting. And it's showing you who uses that information. So obviously financial, we have internal people that are using it, but we also have external, where managerial side is more internally used. The purpose of it, financial, we're helping those external users, make investment, credit, and other decisions. Where when we look at managerial accounting, we're helping the people inside the company make planning and controlling decisions. You can go down through the list and compare each of them, but you can see that there are differences in managerial accounting versus financial accounting. When we think back to, what kind, the expertise that's involved in it, we talked before about financial accounting having a CPA or a certified public accountant. Managerial accounting is going to use a certified management accountant or a CMA. And they have a mix of expertise in financial accounting and in strategic management. So they're geared more toward the function of how a company works from the inside. One thing we have to look at when we think about, managerial accounting is we have to concentrate on fraud and ethics. We've talked before about how fraud can be avoided, but we want to think about, how can fraud inside a company happen and what can we do to prevent them? Well, way back in chapter 8, we talked about internal controls. Internal controls is how you're going to prevent that fraud from happening inside your company. You have to have very strong internal controls because, again, you're setting up those things to make sure that you can, handle when things happen in your company and know what the process should be. So going back to that, kind of refreshing your memory, when we think about fraud and how ethics plays into it, it's really important in how we run our business. So fraud is where you're using your job for personal gain by deliberately misusing employers' assets. An example of that could be you might have an employee that steals cash or other assets, but it could also be something as far as like a payroll scheme, or you might have someone that did financial statement fraud. They might overstate their reimbursable expenses to get more money back from the company. So there's a lot of different things that can be. And we talked before about the 3 factors that have to exist for a person to commit fraud. We said they have to have the opportunity, so that means you left some kind of a hole in your internal control. There might be financial pressure from the outside, something, driving them to take that financial gain. And then after they commit it, they have some kind of rationalization as to why it was okay to do that. And that was what we knew as the fraud triangle that we talked about in chapter 8. So fraud is going to affect all businesses, and it is costly. When we look at, estimates, businesses typically use about 5% of annual revenues to fraud, and that's just an average. Some are definitely less, some are more. But making sure that we know how to fight this fraud and other things that come up require that we have strong ethical boundaries set up in our company. So we talk about ethics, that's where we have the beliefs that we distinguish right from wrong. So there was accepted as standards of good or bad behavior. Sometimes that could be, a hard path to clearly state to know exactly how to handle every situation. The Institute of Management Accountants, or the IMA, they are a professional association for management accountants, and they have a code of ethics that helps in solving ethical dilemmas. So it requires that management accountants be competent, maintain confidentiality, that they act with integrity, and they communicate information in a fair and credible manner. So that's one way to try to get to that, elimination of what do we do in those ethical dilemmas? How do we handle that? And it's by having a policy that helps you do that. All right, the last part of this section just talks about different career paths. And again, when we're thinking about, the managerial side of it, there are a lot of different options inside of a company that you can excel at. For accounting, it's not always just the accounting department. It's not always just the tax side of it that are, in external agencies. It can be inside the company. And they give some examples here of top level, senior, and mid and entry level jobs that are considered, the accounting inside the company. All right, so let's look at the next part. This is where we're going to look at the managerial side, and we're going to have to analyze costs in a little more detail than we've done on the financial side. So let's start by looking at fixed and variable costs. So we see here that they give us fixed and an illustration of variable. So what are fixed costs? What does fixed costs mean? It means this cost is going to be the same no matter how much activity you have. So you could have 0 products that are made and you still have that same fixed cost. Where a variable is going to depend on how much activity. So there's obviously usually a minimum amount, but the more you make, it's going to increase those costs. So those are variable. It changes in line with the volume of activity that you have. When we think about the types of cost classifications, costs can also be traced if they're a direct cost or an indirect cost. So a direct cost means that any cost that we can link to a single cost object. Cost objects are going to be products, processes, departments, or customers. When we think about indirect costs, they cannot be traced to a single object. So for example, the lighting, the heat, the insurance on a complete building, the taxes on a building. The wages of maintenance employees that are working in several different departments, or supervisor salaries that are supervising more than one department. So those might not be easily traced to one direct cost. So anything that's not direct is considered indirect. Next, we want to look at these classifications broken down a little bit more by function. So we can break these costs down further by product and period costs. Product costs relate to creating a product. So direct materials, direct labor, factory overhead, or manufacturing overhead. Anything other than direct materials and direct labor falls into that factory overhead or manufacturing overhead costs. We're going to talk about each of those in just a minute. When we talk about period costs are non-production costs and are usually associated with activities that are linked to a time period rather than associated with a product. So good examples of them would be the sales staff salaries, the wages of the maintenance workers, advertising expenses, depreciation on office furniture and equipment. Those period costs are expensed in the period when they're incurred as a selling expense or as a general and administrative expense. When we look at product costs, they're recorded as cost of goods sold when the products are sold. When we look at how the flow goes for period and product costs, period costs are expense. They go directly to an operating expense. Product costs go into inventory and they follow the flow of the inventory cost. So when it's sold, it goes to cost of goods sold. If it's in inventory, it's on the balance sheet. Period costs are non-production. They're linked to the period of time. So again, things like salaries of staff that are linked to the time that they work. Advertising expenses, they're related to the time of that advertising campaign. So it's a little more specific. When we look at identifying some examples, we can look at the ones they give here. They break it down into fixed or variable, direct or indirect, and then period or product costs. So it's important to understand that they can be classified using any of the combinations here. When we look at factory rent, it's classified as a product cost, but it's fixed because it's the same no matter how many units we produce, but it's indirect with respect to the actual product. So they give lots of examples here of classifications to show you different cost items incurred in manufacturing, and in this case they're using mountain bikes. So the finished bike is the cost object. So allocating these correctly for the cost and the managerial decisions are based on the cost data and depend on us classifying these costs correctly. When we look at the cost concepts for service companies, it's a little different. So the cost concepts are typically going to be looking at an example of Southwest Airlines. We're assuming the cost object is a flight. So the airline's cost of beverages for passengers is a variable cost based on the number of flights, right? But the monthly cost of leasing the aircraft is fixed because it's not based on the number of flights. We have to pay a certain amount every month, no matter if we use 10 flights or 1 flight. We could also trace a flight crew salary to a specific flight, where we cannot trace wages for the ground crew to a specific flight. So those classifications for service companies become a little different. Alright, so this is where we're going to stop for this section. We'll continue in part 2 for chapter 18, and we're going to look more at these manufacturing costs and get into a little bit of detail for direct materials, direct labor, and manufacturing overhead. Thank you.